Hello, and today we are going to be discussing the housing market update for January 2022. So here's a quote from Bill McBride, the founder of Calculated Risk, and it says, "It is possible that rising mortgage rates will slow the housing market, or the Fed might raise rates sooner than expected due to the recent pickup in inflation. But I believe one thing is certain: inventory will tell the tale." So we're going to get into some of the inventory stats so we can see exactly what Bill McBride's talking about. So here's the bad news. Listings are at record lows. I'm about to show you a map that is broken down by state and by percentage of reduced inventory. So as you can see across the nation, with the exception of Idaho, everybody is at a significant loss. Here in Texas, we are 23.1% below, and the national average is 26.8% below. Check out Alaska, it's 33.8% below. And then you've got Vermont, it's 50.8%. Connecticut's 57.8%. Florida's at 48.1%. Hawaii's at 49%. So we're missing a lot of houses. So what does this mean? So here's a graph that shows since 2019 the months of inventory of homes that we have for sale. So if you look at May of 2020, we had 4.6 months of inventory, and this is as a nation. Now, if you look at December and January, so December of 2020, January 2021, we had less than 2 months. It's picked up a little bit and it leveled off around July and August, but here we are in November, and it's 2.1 um, months of inventory. So significantly less. We're just 0.2% away from being tied with the lowest period of time since 2019. So let's take a look at buyer activity. Showings are still strong and they're greater than last November. And this is coming from Showing Time's monthly index. So in November, they had 176 was the Showing Time monthly index. Right? And now what that's telling us is it's kind of giving us an idea of how much activity is out there. And so if we go back to the slides before May and August, where we had the largest inventory, that has also had the highest showing index as well. So showings crushed pre-pandemic numbers. Now this is going over the last 5 Novembers. Okay, and the data I'm giving you is from November because it's always a quarter behind. So what we're looking at is in 2017, we had 103.9. Now we're at 175.7. So there's a lot more showings going on, meaning there's more buyers out there than there was in 2017, 2018, 2019. 2020 was pretty busy. 2021 was nuts. So showings traditionally lag during the holiday season, but the data we're seeing tells us that buyer demand remains strong. And then the fact that every region showed a year-over-year increase indicates that buyers are undeterred. It speaks to their desire to keep searching for their next home. Now, this is a direct quote from Michael Lane, who's the VP and General Manager of Showing Time. So that's where we're getting all this data from as far as the showing indexes. Now, pending sales are higher than pre-pandemic numbers as well. But if you look at 2021, there's a slight dip. So pending home sales over the last 5 Novembers, 2017 we had 109.6, and we're at 122. So we're still well above 2017, 18, and 19, but it's dropping a little bit in 2021. Now, the equity growth in 2021 far surpassed any of these other years. It was about 27% here in San Antonio and about 18% total for the nation. So they're expecting it to be about 5%. Usually in 2017, 2018, 2019, we were seeing about 3%. In 2020, about 3 to 5%. 2021, we saw 27%, and now they're expecting it to drop down to about 5%. But until the market kind of kicks into its normal routine, we're not going to be able to know for sure. So home equity. Okay, let's go start talking about home equity. Now, this is from 2021 Realtors Conference and Expo, and it's saying that the lack of insight around home equity presents an opportunity for real estate professionals who are always looking for touch points with past clients. And what does that mean? It means this. Now, per CoreLogic's third quarter homeowners equity report, the average home equity gain for U.S. homeowners with mortgages was about $57,000. So year over year percentage increase in equity for U.S. homeowners with mortgages is about 31.1%. And then the year over year total increase in equity for the United States homeowners with mortgages was over $3 trillion. So CoreLogic was saying this summer, home prices growth reached the highest level in more than 45 years, pushing equity gains to another record high. Now it goes back to that 27%. Now, homeowner equity growth is still surging. This is the third quarter of 2021 year over year from third quarter 2020. Again, the data is always going to be a quarter behind, but this is where we're looking at. So check out California, $119,000 in home equity growth. Texas, $43,000. New York, $49,000. Florida, $64,000. Seattle, $96,000. Alaska, $24,000. Hawaii, $113,000. So now, this is from Frank Martell, the president and CEO of CoreLogic. He said that not only have equity gains helped homeowners more seamlessly transition out of the forbearance and avoid a distressed sale, but they've also enabled many to continue building their wealth. Because that equity growth, that's just, I call it free money, if you will, because it's just growing there naturally. So another quote from Odita Kushi, he's the deputy chief economist with First American. He said that the U.S. households own $36.8 trillion in owner-occupied real estate, 11.5 trillion in debt, and the remaining 25 trillion is in equity. That is insane. I mean, that's well above what our country is in debt. Now, in inflated adjustment terms, homeowners had an average of 294,000 in equity in quarter three 2021, which is a historic high. Now, what can we expect in the 2022 housing market? Fantastic question. So, mortgage rate projections. This is as of December of 2021. So, for the first quarter, they were looking at an average of 3.3%. If you look down to the fourth quarter, it's 3.7%. About mid fourth quarter of 2021, they were projecting interest rates to be between 4.25% to maybe 4.5%. So we'll see how this inflation is going and if they're going to raise the interest rates to try and curb some of it. Now, what about forbearances? The forbearances finally fall below 1 million. Now, a lot of people were thinking that there's going to be a lot of foreclosures and stuff because of it, the forbearance program, but that just didn't happen. And here's the monthly numbers basically from May of 2020. We can see that we were at 4.76 million homes, and right now we're about 890,000 homes. We may see a little bit of an uptick in foreclosure rates in 2022, but just an uptick though from an extraordinary low level. We're not expecting to see a big increase. We expect delinquency rates overall on home mortgages to actually continue to remain quite low. And that's from McClare Bolton Smith, the senior leader of research at CoreLogic. Now, a lot of people were afraid we were going to have a big foreclosure, short sale, properties being distressed and given back to the lenders when we entered into this forbearance program. But that spike of 18% nationwide, 27% locally, has given enough equity boost to owners to where they can sell and be able to get out of their house without having to go through foreclosure or through a short sale. Now, has home price acceleration peaked? Potentially, right? Because it goes back to what we were talking about before. We had that big, huge spike. And now if you look at the graph, it's kind of leveling off. The FHFA is showing a little bit of a decline. CoreLogic's showing a plateau with a little spike up there in November. And then the S&P Case-Shiller is showing a little bit of a decline. Like I mentioned earlier, this past year we had a 27% increase in home equity on average. And this year they're expecting about 5%, which is still almost twice the percentage as what a normal market was when it was about 3%. So home price forecast for 2022. So the average of all forecasts, 5.2%. Fannie Mae thinks it's going to be about 7.4, Freddie Mac 7%. If you go down to Zelman's and NAR, they're both about 3%. So McClare Bolton Smith, again the senior leader of research at CoreLogic, said that overall, I do not think that 2022 will be another strong year for housing, albeit a little bit higher mortgage rates, and we do think home sales will continue to rise and actually reach a 16-year high in 2022. So they do think that 2022 will be another strong year, and it looks like we may be able to reach a 16-year high in 2022, but the appreciation is expected to be about 5%, as I mentioned earlier. So here are some of the resources where the data has been collected from. So here's some updates. All this data is where the updates came from, and it's quote in each slide. Now, let's get into home sales. So the average days on the market in November of 2021, if you look at that, it is just insane. In Texas, the national average was 18 days, but in Texas, it's that dark one. It says up to 15. So up to 15. Crazy in Alaska. So 15 to 30 is the mid shade blue. I guess in Wyoming, it's just off the charts. Like it's, I don't know, a million days. Who knows? But for the most part, this graph coincides with the same data that I showed earlier with respect to the shortage of inventory. So existing home sales. If you look in January, well, I say probably what maybe May of 2020, there's a big dip, and then it just spiked crazy up. Probably was that about August maybe. So the 6,800,000 existing home sales was like the peak number, so they almost got to that. So probably about 6.5, 6.6, somewhere around there. Existing home sales year over year by region. So as the United States, it was 2%. The Northeast, 8.7% deficit. So the Midwest and South about 4.5 on average. The West 1%. So existing home sales in the thousands. So the light blue is 2019, the gray is 2020, the dark blue is 2021. So you can see in June of 2021, it was significantly higher. See how it's starting to taper down a little bit. So it's still good. It's still, comparable. We'll wait and see what December's numbers finally come in at and see where it relates to 2020. New home sales. New home sales were quite higher in June, July, August, September, October, November, and December of 2020 versus 2021. Why? Because my thoughts are that we had the building supply shortage, labor supply shortage. A lot of the builders were not even putting houses on the market till they got the countertops in because the prices were just skyrocketing so much and out of control. They were slowing down their production and putting things on the market until the houses were almost complete so that they could price it accordingly and absorb some of these impacts for the labor and material increases. So new home sales, this is annualized in thousands. So we're at 760,000 or so in January of 2021. So a lot higher. So see that again, 2020 was just nuts. Now we're kind of tapering back off to a more normal market. So new home sales, percent of distribution by price range. Now this is less than 500 units or less than 0.5%. And that's what the asterisks right there mean. Okay, so not very many houses are coming in under $200,000 for new homes. The majority of them were between 300,000 and 400,000, and then it kind of plateaued at between 400 and 749, and then dropped over 750,000. This is because most of the buyers are in this price range right here. Okay, and then tapers down. New homes selling fast. The median months for completion of sold properties. So if you look at October and November of 2021, dropped quite a bit. So we're at like 2.5 and 2.7. Again, back in March, we had 5.1. So a lot of change going on. Total home sales in the thousands. So if you look right here, we're at 601. It'd be interesting to see we had a little uptick of to 566 for November versus 554 of November of 2020. So we'll see if December comes in a little bit higher than 601 or a little less. So pending home sales, 100, that dotted line is historically a healthy level. Okay, so we're sitting at 125 as of probably December of 2021. So doing pretty good. We had a lull right there in about February of 2020. That's when COVID happened. Everybody was kind of, trying to figure out what was going to go on. And then it just shot out of the roof. The rates dropped. Everybody started to reshuffle their homes because they could work from home, things like that. Now, pending home sales year over year by region. If you look, everybody had less pending home sales than the except for the Midwest. The Midwest barely crested even. What does this tell you? This is telling you that there's less houses that are being sold because there's less inventory on the market. Okay, the Northeast especially, and the South is we're a little bit below. The West is quite low, and then as an average, the U.S. is 2.7%. Now, the percentage of distressed property sales, if you look at it, this is a wonderful chart to see. Okay, because in 2012, 2012, we were about 35%. Now, if you look at the end of 2021, less than 1% of sales. That was as of November. So less than 1% of the houses on the market are due to foreclosure or short sale. That's phenomenal. Now let's talk home prices. Sales price of existing homes year over year by region. If you look at us in the South, 18.4%, as an average 13.9% of the market here in the United States. Now, the percent of change in sales year over year by region. Okay. Now, if you look, we're up to 50.7%, which is a phenomenal amount because, again, we went up 27% alone just in 2021. So the data, the minus 14.8%, that is for houses between $0 and $100,000. Then 100,000, 250, we're still low. Once we get to the 250 to 500 mark, it pops up. The 500 to 750, and so on and so forth. So the $1 million houses had a 50.7% change in sales year over year. So changes in home prices year over year. That's just another graph of showing you where we're at. So on average, we did 27%. As a nation, it was like 18%, but they're peaking here about 19% right here on the change of home prices. So this is using the 20 city composite, so all the 20 metropolitan areas. So like Houston, Austin, San Antonio, Los Angeles, New York City, et cetera, the big metropolitan areas. So if you see, again, in January of 2020, between 2019 and 2020, they had that little lull, and then it just shot right back up. So prices have just gone up dramatically since, since about April of 2021. They just like took off like bat out of hell. Now, as you can see, in October and September was a slight dip, and then October dropped a little bit. So we'll see what comes out within November and December data. So changes in home prices year over year. Again, so we're looking at it as about 19.1% in October. So year over year percent change in price. So the current was 18.1%. All right, again, here in San Antonio area is about 27%. They're forecasting 2.8 per CoreLogic. That number is actually a lot of people are coming out again. It was about 5%. This is what that price change is going to be looking at. All right, let's look at inventory. So the seller's traffic index from November of 2021, the dark blue is very strong, and then the blue for Alaska is strong. If you look at Texas, Oklahoma, Kansas, and a lot of the south and north, we're looking at the stable. And then a lot of the west coast and all of the east coast, pretty much except for South Carolina, is weak. And then if you look at South and North Dakota, Wyoming, and Washington, it's very weak. So not a lot of sellers in those markets. Months of inventory of home sales. So 2011 to today, you can see it has just plummeted. Now we've picked it up a little bit after the COVID, or after COVID hit. We got that spike. It's dropped down. Now it's picking back up, and then you can see it's starting to drop down a little bit more. Now another way to look at this data, like if you look at that peak is right here at 4.6, and it's kind of going, you can kind of get a more expanded view of that data. So each of those numbers above the bar represents the months of inventory for home sales. So as of November of 2021, as a nation, we had 2.1% months of inventory. 6% is considered an even market. If it's below 6%, it's a seller's market. If it's above 6 months, then it's a buyer's market. So 6 months is kind of the median to determine the whether it's a seller's market or a buyer's market. So we're almost 4 months below a normal market. So an extremely strong seller's market. So months inventory of homes for sale in the last 12 months. Again, 2.1% for November. Now let's look at the year over year inventory levels. Wow. Lot of red. Okay, we don't want to see red. We want to see like a little bit above or a little bit below that 0%. Okay, now what we're seeing is it's all these other charts. It's just the data represented in different ways. So that peak we had in February of 2021, that's that long drop. Okay, that's 30% is the bottom line there. 30% year over year inventory levels. Now, as you see, the line starting to shorten up a little bit, but then it drops again in November. So, got a little bit of a housing inventory issue. So, year over year inventory levels over the last 12 months. So, it's minus 13% for November. New home month inventory. So, this is seasonally adjusted over the last 12 months. So if you can see in October, we had a little bit more of an inventory for new homes, and it's dropped back down in November. But during December, January, February, that's when we had the real shortage of labor. That's when we had a lot of the lumber prices were going out of the roof and having shortages there as the supply chain starts to fix itself. That's why it's kind of starting to adjust up there. New home monthly inventory, non-seasonally adjusted. So if we're looking at 2020 versus 2021, had a big spike in November and October. Back during the March, April, May timeframe, you're looking at when there's just such a shortage, the sellers of the new homes were just going nuts. They were raising the prices. They weren't working with real estate agents. They were just doing all kinds of crazy stuff. Now we've gotten back to a normal market, and they're now trying to work with realtors to bring them some clients because now that the supply and demand's kind of starting to level back out. Buyer demand. Impressive year over year demand seen across the United States as holiday home showing traffic heats up. Okay, this is pure from showing time. So year over year increase in showing activity for November of 2021. Michael Lane, the vice president and general manager of Showing Time, said that showings traditionally lag during the holiday season, but the data we're seeing tells us that buyer demand remains strong. The fact that every region showed a year over year increase indicates that buyers are undeterred by the approaching holidays, and it speaks to their desire to keep searching for their next home. Okay, so down here in the South, we're looking at 13.6% higher than normal. Here's buyer traffic. Okay, so no states appear to be in the very strong. Almost all the country is in strong. fewer and stable, and only Idaho seems to be very weak. So maybe you can go to Idaho and get a good deal on some property and some potatoes. Let's talk mortgage rates. So mortgage rates, 30-year fixed rate from January 2016 to today. So 5% would be the cap. That was in 2018, the end of 2019. You're starting to see about 5%. Before COVID, they were about 3.5%. Then we dropped down to about 2.75. I've seen some as low as 2.5 and 2.25. Those are just phenomenal rates. So they're right now the average is 3.22%. And that's as of January 6th. So January 18, as of today, all this is doing is compiling the data a little bit less spread out. Let's look at projections. Okay, we kind of talked about this a little bit earlier, but Q1 we're at 3.3, Q4 3.7. They are again talking about maybe hitting the 4% mark depending on how inflation is looking. So let's look at the actual versus projected. So in 2018 we had that high, 2019 a big drop, 2020 even bigger drop, then it peaked up, then we were starting to have some more issues, so it dropped a little bit, and then it shot up right at the end of the fourth quarter. And now it's projected to just continually move up to about 3.8 or so. All right, here's just another graph of showing you that data for the projections. So first quarter, it looks like it's about 3.4, and it's going to be raising projected about 0.1% for the next 3 quarters after that. Let's talk about mortgage credit availability. So mortgage credit availability index, the McKay, from November of 2021, we had a lot of mortgage availability. Then it dropped in January 2020, right? And then it's kind of just fluttered around from there as we've been dealing with COVID. So lending standards are still under control. So historical data for the mortgage credit availability index is showing about 124.9 as of November. The housing bubble, we were at 868.7. So what this is saying is back in when we had the housing bubble, everybody, you had a heartbeat. How much did you want a loan for? Cool. Hey, Bobby, I got an appraisal needed at 123 Smith Street. I need it to come in at this dollar amount. Don't worry about comps. Okay, we'll do that. And then or it was, hey, look, we can get you in at, a 0.5% interest rate. And then in 5 years, you're going to have a balloon payment of $150,000. Sound good? Oh, sounds good to me. All right, cool. Let's get you into house. Well, then in 2007, that all changed, right? And in 2008, we had the housing market crash, and that's why it's a significant drop. Well, the government changed their rules for lending practices and things like that. So as you can see, since the housing market crash, it's never even topped 200. So well above any kind of bubble. So people are talking about there's going to be a bubble. There's going to be a bubble. When's it going to be popping? There is no bubble projected. There's no data that indicates that we're even close to having any kind of data showing that we're going to have a bubble. So the average days to close a loan over the last 12 months, 47. That's from from September. So typically we do about 30 days to 45 days. If you can see back in December 2020, January 2021, it was higher. If you look, it goes a little higher during the holidays, right? Because we have holidays, things to get, people take 3-4 days off, things like that. So it adjusts the data some. So let's check out the average FICO scores over the last 12 months. So when they're buying a house, this is the average credit score. So before when we had the bubble, they were like, "Oh, you got a heartbeat and a job? Oh, you just got a job? Cool. You quit your job? Don't worry. Are you going to get a new one? Yes. Okay, cool." Well, now they tightened everything up. A lot of lenders won't even do credit or loans with people with credit scores below 650, 660. So the average right now, as of September, was 740. But if you look at 740, 750, so that's good. It's showing that people that are borrowing money are more responsible with their money when it comes to their FICO credit score. Let's check out the distribution. So if you look at all the credit scores, there's only 0.02% of the population of buyers, 500 to 549, 0.35 from 550 to 599, and then 6.47% is at 600 to 649. Okay, now why would they be lower when the average is in the 740s? Okay, like so VA loans do not have a credit score requirement. If you're a veteran and you served honorably, if you're in the military and you serve honorably, the VA has not put up a credit score requirement. If you're talking to a lender and they're talking about their credit score requirement for a VA loan, that is their decision. They call it an overlay. That's their overlay to protect their company. But the VA loan as a whole does not have a credit score requirement. So between 500 and 749, that makes up almost half of the buyer pool. And then from 750 to 800 and up is the other half. So the average FICO score for closed purchase loans for VA was 720, FHA 676, conventional 755. The all loans average was 740. So it's pretty interesting because the VA does not have a credit score requirement, but if you look, the military pretty good with their credit score. So the average back end debt to income, that's what DTI stands for, debt to income for closed purchase loans for VA was 41%, FHA 43%, conventional 35%, and all loan average of 36%. Now, this is the last slide for this presentation. I will see you next month with February's data, and hopefully then we will have enough data from December so we can roll up the entire 2020 year and see what we have to look forward to coming into 2022.